School of Management Studies IGNOU presents an audiobook on the course MMPC 003 Business Environment for MBA program. Presenting Block 1 Introduction to Business Environment, Unit 2 Economic Growth and Development Part 2. National income. Macroeconomics is the study of the economy as a whole and one of the most important macroeconomic variables that represent the economy as a whole is national income. In macroeconomics, the variables like aggregate consumption, investment, employment, and even price levels are determined by the level of national income, and hence the study of national income is important. Further, estimates of national income help in understanding and measuring the standard of living and economic welfare of the citizens of the country. The figures of national income are helpful in making international comparisons about the economic status of the economy. The planning process of the country is heavily dependent on national income, as these estimates help in shaping the future policies of the country. In a nutshell, national income helps us to understand the economic growth and trajectory of the economy. In the context of national income accounting, that is NIA, gross domestic product, that is GDP, is one of the most essential components. The entire series of national income revolves around this component. Most importantly, figures of national income are derived from the figures of GDP. So to understand national income, it is essential to understand GDP. In simple terms, GDP is the market value of all final goods and services which are produced by residents of a country within the domestic territory of a country in a given period of time. A few points about GDP needs to be understood. First, it is the market value of final goods and services. Market value is reflected as market prices, and market prices indeed represent the willingness to pay by the consumers. So the value of goods and services are reflected by market prices. Second, it includes only the value of the final goods. It means that the intermediate goods are excluded when calculating GDP. It is because to avoid the problem of double counting. Third, goods and services produced by the residents of the country within the boundaries of the country are included. And fourth, it measures the value of production which takes place within the specific time period, usually fiscal year or a quarter. GDP indeed measures total income and total expenditure in an economy. However, they both are the same because for an economy as a whole, income must equal expenditure. Let us take an example. In every economic transaction, there are two parties, namely buyer and seller. So one person's income is the other's expenditure. For example, Mehta decorator and painters were given the order to paint the courtyard of Mr. Verma, and the deal was signed off with the contract of Rs 10,000 for doing this work. In this example, Mr. Verma is a buyer of the service and Mehta decorator and painters is the seller. The company earns Rs 10,000 and Mr. Verma spends Rs 10,000. In this example, the amount of Mr. Verma expenditure is equal to Mehta decorator and painter's income. Further, both expenditure and income in the above is same, that is Rs 10,000. Major concepts and measures of national income. Gross national product or GNP. It is the market value of all final goods and services produced in the year along with net factor income from abroad, that is NFIA. NFIA is the difference between factor income received like rent, interest and profit from abroad and factor income paid abroad. Hence, GNP equals to GDP plus NFIA. Net National Product or NNP. It is the market value of all final goods and services produced by country citizens both domestically and internationally in a given period. NNP is indeed national income that is available to the economy for consumption and investment. NNP divided by total population gives per capita income. Hence, NNP equals to GNP minus depreciation. Per capita income equals to national income over population. Net domestic product or NDP. It refers to the economic output of the country adjusted for depreciation or consumption of fixed capital. That is, NDP equals to GDP minus depreciation. Market price. When any measure of national income like NNP is calculated at a market price, it includes the cost of production and also various taxes and subsidies which are imposed or provided by the government. Net indirect tax is the difference between indirect tax like goods and service tax or GST, value added tax or VAT, etc. and subsidies. Factor price. In contrast to market price, factor price excludes the effect of net indirect tax. Personal income or PI. Personal income is the income which an individual or household receive from all the sources before paying taxes. It includes income from factor services like wages, rent and interest, along with transfer payments like pensions, social security benefits, etc. The personal income includes transfer payment which is not included in national income. Disposable income. It is income that is left with individuals after paying taxes and other compulsory payments to the government. It is the actual amount of money that is in the hands of the individual for undertaking consumption and other expenditures. Hence, disposable income equals to personal income minus taxes, minus fees, minus fines. Different approaches of estimating national income. There are primarily three approaches of measuring national income, namely product method or value added method, income method and expenditure method. Any one of the three methods can be used to estimate the national income of the country, but on the assumption that necessary data is fully available. Let us now understand these methods in brief. Product method or value added method. In this method, we calculate the aggregate annual value of goods and services produced in a year. Here GDP is the sum of gross value added by the entire production units in the economy. Value added of a firm is the value of production of the firm minus the value of intermediate goods used by the firm. In simple words, value added by firm equals value of output minus value of the inputs, that is, intermediate products. How to go about the aggregating annual value of goods and services? Does it mean we add up the value of all goods and services produced by all the firms in an economy? Let us understand this with the help of an example. Suppose there are two producers in the economy, one producing cotton and the other producing cloth. For simplicity, we assume that the cotton producer uses only one input, that is human labor, and he sells some part of the cotton to the cloth maker. The cloth maker does not need any other raw materials besides cotton to produce the cloth. Let us assume that in a year the total value of cotton that cotton producer has produced is rupees 500. Out of this, he has sold rupees 300 worth of cotton to the cloth maker. The cloth maker, having used cotton worth rupees 300, has produced cloth worth rupees 1000. Based on the example cited, what is the value of total production in the economy? If we were to simply add up the contribution of each producer, then the value of total production would be rupees 500, that is value of production of cotton producer, plus rupees 1000, that is value of the output of cloth maker. The result would be total production of rupees 1500. However, this estimate is not correct and the value of aggregate production is not rupees 1500. The value of production which the cotton producer has generated is indeed rupees 500, as he has not paid any amount for the use of intermediate goods, that is raw material. Though the same is not true for cloth maker. The cloth maker has bought cotton worth rupees 300 for making cloth. Hence, the rupees 1000 worth of cloth that he has produced is not entirely his own contribution. To calculate the net contribution of the cloth maker, we need to subtract the value of cotton that he has bought from the cotton producer. If we don't do this exercise, then we commit the error of double counting, that is, counting the value of good more than once. In this case, rupees 300 worth of cotton will be counted twice. One as part of output produced by cotton producer and second as the value of input while producing cloth. Therefore, the net contribution made by cloth maker is rupees 1000 minus rupees 300 equals to rupees 700. Hence, the aggregate value of goods produced in this example is rupees 500, that is, net contribution by the cotton producer plus rupees 700, that is net contribution by the cloth maker, and it is equal to rupees 1200. We can use the term value added to denote the net contribution made by a firm. Therefore, the value added of a firm is the value of production of the firm minus the value of intermediate goods used by the firm. If we add the gross value added by all the firms in the economy in a year, we arrive at a measure of the value of the aggregate amount of goods and services produced in the economy in a year. Such an estimate is called GDP or gross value added. The value of net national income NNP and gross value added or GDP can further be easily calculated by following certain steps. They are: GDP at market price equals to sum total of gross value added of all the firms in the economy. NDP at factor cost equals to GDP at market price minus depreciation minus NIT. Here, GDP is at market price. NDP at factor cost equals to net domestic product at factor cost. Depreciation is the regular wear and tear of the capital, also called as consumption of fixed capital. NIT stands for net indirect taxes. Hence, NNP at factor cost equals to NDP at factor cost plus NFIA. Income method. In the production process, the producer makes use of factors of production, namely land, labor, capital, and entrepreneur. In return for their services rendered, they receive rent, wages, interest, and profit, combinedly called factor payments. Under the income method, national income is measured by aggregating these factor incomes generated by different producing units within the domestic territory of the country in one fiscal year. The different components of the income method are the compensation of employees, rent, interest, profit, and mixed income. Wages and salaries paid in cash and kind, and the contribution made by the employer to the social security scheme of employees are the major components of compensation of employees. Rent is the payment that accrues from ownership of land and building. Interest is the payment that one receives from lending his funds. Profit is earned by an entrepreneur and it has three components, that is, corporate tax, dividend, and retained earnings. Corporate tax is the tax paid to the government. The dividend is paid to the shareholders of the company, and some part of the profit is retained as the reserves to meet unforeseen contingencies or for business expansion and growth, and it is termed as retained earnings. Income earned by self-employed persons is termed as mixed income. The sum of these five components gives us the value of the net domestic product at factor cost. That is, NDP at factor cost. NDP at factor cost equals to compensation of employees plus rent plus interest plus profit plus mixed income of self-employed. Further adding net factor income from abroad, that is NFIA, which is difference between factor income which is received from abroad and paid abroad, gives the value of the net national product at factor cost, that is national income. Hence we can say that NNP at factor cost equals to NDP at factor cost plus NFIA. Expenditure method. Under the expenditure method, national income is measured as the sum of all final expenditures. Final expenditure consists of expenditure on private consumption, gross investment incurred by both private and public sector, government expenditure, foreign expenditure on our exports, and net of our expenditure on imports. Major components of the expenditure method are: number 1, private consumption expenditure. It includes expenditure by the households on both durable and non-durable goods along with different services. Number 2, Investment or gross fixed capital formation. It includes expenditure undertaken by both households and government for investment purposes. Number 3. Government expenditure. Expenditure undertaken by the government on the purchase of goods and services, along with expenditure on building infrastructure, payment for salaries, etc. And number 4. Net export. It is the difference calculated by subtracting total imports from total exports. It represents the contribution of the foreign sector to the GDP. Some precautions while estimating national income. Certain items must be excluded while measuring national income. They are: number 1, the expenditure of intermediate goods and services, otherwise it leads to the problem of double counting. Number 2, transfer payments like scholarships, pension, etc. Number 3, income earned from second-hand goods. And number 4, income from sales of shares, bonds, windfall gains like lotteries, etc. Inflation. In this section, you will study the meaning of inflation, its measurement, and how does it affect different sections and dimensions of an economy. Definition of inflation. Many economists have given different definitions. According to Colborn, and I quote, inflation can be understood as a situation whereby too much money chases too few goods, unquote. According to Crowther, and I quote, a situation in which the value of money falls and price rises is inflation, unquote. Samuelson says that inflation denotes a rise in the general level of prices. These definitions and many other definitions have one or another deficiency, but economists are unanimous that inflation refers to a persistent and appreciable rise in the general price level. However, the word persistent and appreciable are not clearly defined, so there is a space for ambiguity. Whether 5%, 10% or 30% rise in price per month or per annum is considerable, or there is some other rate that is deemed to be appreciable. The issue of inflation is of utmost importance because it has both positive and negative consequences. A rise in prices is necessary for producers to induce them to maintain a regular supply of goods and services in the market. But higher prices lead to more burden on the consumer pocket. So what an economy needs is a modern rate of inflation. This takes us to another question: what is a moderate rate of inflation? So what an economy needs is a moderate rate of inflation. This takes us to another question: what is a moderate rate of inflation? The answer to this question varies from country to country depending on the level of development. For instance, in the case of India, a committee set up by the Reserve Bank of India to review the monetary system, which is popularly known as Chakravarti Committee, in 1985, recommended that 4% rate of inflation is desirable for India's economic growth. Different methods of measuring inflation. There are two common methods of measuring inflation. They are changes in price index number, that is PIN, and gross national product deflator, that is GNP deflator. GNP deflator. GNP deflator is known as GNP implicit price deflator. It is called implicit as it is not directly obtained like CPI and WPI. It can be obtained by the formula, which is GNP deflator equals to nominal GNP over real GNP into 100. Nominal GNP is the GNP at the prevailing prices and real GNP is GNP at constant prices of the base year. We can calculate the GNP deflator for any year by this formula. Assume that we want to calculate India's GNP deflator for the year 2015-16. Let India's nominal GNP in 2015-16 be rupees 150 crore and her real GNP be rupees 100 crore. That is GNP at some constant price of the base year, say 2010-11. Now India's GNP deflator for 2015-16 can be estimated as GNP deflator 2015-16 equals to 150 divided by 100, which is 1.5. In percentage terms, it would be 150%. It means that India's nominal GNP in 2015-16 was 150% higher than her real GNP in 2010-11. Similarly, the GNP deflator can be worked out for different years. Once the GNP deflator is worked out for different years, the rate of inflation can be measured by the percentage change in the GNP deflator between any 2 years. For example, let us assume that the GNP deflator for the year 2018-19 is 125.4 and for the year 2019-20 is 135.6. Given the value of GNP deflators, the rate of inflation between 2018-19 and 2019-20 will be rate of inflation equals to 135.6 minus 125.4 divided by 125.4 into 100, which gives us 8.13%. Out of these two indices, the GNP deflator is considered to be better because of its broadest coverage. Different types of inflation. The major types of inflation are: number 1, creeping or moderate inflation; number 2, galloping inflation; and number 3, hyperinflation. Creeping or moderate inflation. Generally, when the rate of inflation is single digit, it is termed as the creeping or moderate rate of inflation. This type of inflation is mostly expected by both consumer and producer, and they plan economic activities accordingly. Galloping inflation. When inflation is in the double-triple digit range in a year, it is termed as galloping. This type of inflation erodes the savings of the economy and has a disastrous effect on the fixed income group. Hyperinflation. Under hyperinflation, price rises by more than 50% a month. During this period, paper currency loses its value drastically and the monetary authorities print the currency of the highest possible denomination. Hyperinflation mostly occurs in times of war and economic turmoil in the economy, as heavy surge in prices for basic goods such as food and fuel is witnessed during hyperinflation. World history has many examples when economies witness the episode of hyperinflation. For example, in Germany, the wholesale price index increased by 100 million% between December 1922 and November 1923. Similarly, Zimbabwe experienced hyperinflation between 2004 and 2009. Causes of inflation. The main causes of inflation are clubbed under two major headings. They are demand pull inflation and cost push inflation. Demand pull factors. Demand pull inflation is due to the increase in demand or aggregate demand in Keynesian terms. According to Keynes, aggregate demand, that is AD, consists of four major components, that is consumption, investment, government expenditure, and net exports, which means AD equals to C plus I plus G plus X minus M. This equation is same as in the expenditure method of estimating national income also. If aggregate demand outweighs the aggregate supply, prices rise. If any of the components of AD increases, then it will lead to an increase in AD, which will further lead to a rise in prices. For example, when the government spends excessively or there are sudden jumps in the export of the country, prices go up. Cost push inflation. The increase in the cost of production is the major cause of cost push inflation. Whenever the cost of production increases, producer tends to shift the burden onto consumers in the form of higher prices. An increase in money wages due to pressure of trade unions, decrease in the supply of raw material, increase in the prices of inputs like raw materials, etc. are some of the major constituents of cost push inflation. Effects of inflation. Inflation affects almost all the economic agents of the economy, be it consumers, producers, or government. The favorable or unfavorable effect depends upon the rate of inflation. Let us understand how does it impact the distribution of income and wealth, producers, wage earners, borrowers, and lenders, and other segments of the economy. Impact on income distribution. How will inflation affect income and wealth distribution depends upon the prices of the output which the producer produces and the prices of the inputs like labor and land. If output prices rise more than input prices, then income will be distributed in the favor of the producer or the profit earner or the employer. The plausible explanation is when the price of output rises, it translates to higher revenue and profit of the producer. So the revenue-wage gap increases and the larger share of the national income goes to the employer or producer. The overall impact is that firm or producer who was already rich, they get even richer, and the poor, especially labor, gets poorer. Fall in the value of money. Inflation erodes the purchasing power of money. It also implies that the real wages or real income decline with a rise in prices. For example, let us suppose that the price of good X was Rs 10 per piece and you have Rs 500 as your money income. So if you spend your entire income on good X, you could buy 50 pieces of good X. Now keeping other things constant, if the price of good X rise to Rs 20 per piece, the same Rs 500 can fetch you only 25 pieces of good X. So the currency denomination remains the same, that is Rs 500, but its purchasing power reduces. You can buy fewer goods with the same currency note or money income. So the money income of the consumer is the same, that is Rs 500. But the real income, that is the amount of goods and services which can be purchased with money income, has reduced with the rise in prices. This type of effect is most harmful to daily wage earners, persons with fixed income, and employees working in the unorganized sector, as they do not have any safeguard against such price rise. Impact on borrowers and lenders. It is the borrowers which tend to gain due to inflation and lender lose. Now suppose you are a borrower and you borrow money at the prevailing rate of inflation. Now when you repay the same amount to your lender, no doubt you are paying the same amount with the rate of interest, but the real value of money has reduced. More specifically, you pay less in terms of purchasing power or goods and services. So your borrower gains and your lender loses. Methods of controlling inflation. Monetary policy is one of the policy options and direct methods of controlling inflation. Reserve Bank of India makes use of monetary policy to regulate the supply of credit in the market. The various tools and methods used within the monetary policy are discussed in the Indian financial system, that is Unit 5 of that particular book in detail. Now let's summarize the unit. This unit has given a detailed account of economic growth and development. A clear understanding of the difference between economic growth and development is of paramount importance. The different theories of growth as discussed in the preceding sections has equipped us with the ideas as to variables like saving, investment, capital accumulation, human capital are necessary for the economy to achieve higher levels of growth. Similarly, the unit discussed in detail about GDP and national income and the various methods with which the national income estimates can be calculated. The value-added method calculates national income from the production side. Income method combines the factors of income like wages, rent, interest, and profit, along with income received from abroad to arrive at national income figures. The expenditure method takes the root of the expenditure side of the economy to calculate national income. In the last section of the unit, you have learnt about the meaning of inflation. The different methods of measuring inflation like CPI, WPI, and GNP deflator, along with various reasons for inflation and the effect of inflation on income distribution, wage earners, fixed income groups, borrowers, and lenders. You were listening to the audiobook by the School of Management Studies IGNOU for MBA program. Course code MMPC 002 Human Resource Management. Course Coordinator Professor Nayantara Padhi from School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ruchi Sharma. Program assisted by Tarannum Jahan. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.